In addition to, of course, what we heard from the IMF about where rates could head after essentially this year and the next few months are going to be critical to that, is there a sense that perhaps market expectations are shortening this rate cycle?
Yeah, for sure. I mean, one of the biggest topics so far this year is how aggressive really the rates market has gotten behind pricing Fed cuts, despite the fact that certainly data has weakened, but some of the more important data, as we saw last week with non-farm, remains somewhat robust. We'll get CPI. We'll see what that says. And that's kept the central banks, for the most part, quite aggressive, at least in their rhetoric. I do think that a rate hike is still forthcoming in May, and data would need to ultimately cooperate to really get the market to where it thinks rates are going to get to by the end of the year.
How are you positioning at this point then, given the magnitude of uncertainty when it comes to the rate environment?
Yeah, I mean, sometimes the most boring investments are those that you can sleep the best with. Cash remains an incredible alternative right here. Keeping that powder dry certainly makes sense. I do think that there is an argument to be made that what we've seen in the banking crisis is the beginning of the Fed possibly over-tightening already. So positioning around kind of that recession view, either from a cash perspective or thinking about how you would want to play various parts of the curve or the relative parts of the equity market is how I would look at things. So 530s, for instance, from a steepening perspective, makes sense to me. And a barbell when it comes to quality growth as well as the defensive parts of the equity market could give you a little bit of both parts of the recession discussion and maybe some aspects, if it's not as bad as some of the estimates are thinking it's going to be.
Marvin, really interesting that you said earlier that at least central banks could be staying hawkish in rhetoric, but we have seen, of course, a divergence already with the RBA, RBNZ, and just other central banks. So how do you play this potential policy divergence that we'll potentially see more of this year?
Yeah, for sure. I mean, looking at the devil and the details around inflation is key. When we kind of look around the world, there's not that much left in rate hike expectations at this point. Most of it is contained in Europe, where they were slower to start. Even with the RBNZ being more aggressive than everyone expects, it's got them to a point where the market thinks that they're done. I think you need to continue to look at those relationships and really see where the flexibility exists. Part of the strength in kind of the U.S. risk story right now is that the Fed has been one of the more aggressive central banks. Its inflation, again, we'll see in the next day or two, is showing signs that it's starting to cooperate. That's something that a lot of the European economies and central banks don't have the advantage. So you do run this divergence, which breaks into the minutia of just where we are in each one of these cycles.
We were talking a bit earlier with another guest about EM carry trades and how they've outperformed developing market peers. I wonder where you see the biggest opportunities among economies that post a positive real yield advantage.
Yeah, I mean, certainly I think real yield in an environment where we get a little rate stability, and we've had a little rate stability for at least the last week or so, but we also saw how volatile those markets can be. As we kind of get closer to the end of the cycle for the Fed and most of the other central banks, I think you'll get comfortable being able to say, okay, well, the volatility around how quickly those expectations can move around the DM gives us a chance to take a step back and look at the EM. And really a lot of the biggest EM carry opportunities right now are in LATAM, where they have been aggressive, and some of those inflation numbers are starting to peak or come back in the opposite direction. But it really does depend on your outlook on the Fed and whether or not you think that overall rates volatility starts to calm down from what we've seen really over the last few months.